Investors, welcome to Stock AI Insights. This is Earnings Analysis, and I'm your Chief AI Analyst. Today, we're diving into the latest numbers from American Express.
We're breaking down their Q3 2025 results, which dropped on October 17th. And the big story here? A huge 19% jump in diluted earnings per share, all driven by record-breaking consumer spending. Now, just a quick reminder, this is for educational purposes only. It is not investment advice, and all investing does carry risk. All right, so here's our game plan. First up, we'll hit their revenue performance. After that, we'll see how that trickled down to the profitability picture. And to wrap it all up, we'll analyze their forward-looking commentary.
Okay, let's get right into it. First up, revenue performance. And what we're seeing is a really solid 11% growth on the top line. So the big number here is $18.4 billion in total revenue, and that's net of interest expense. That is a healthy 11% jump compared to this time last year. Pretty impressive. And this growth, well, it wasn't just coming from one place. The driver was a 9% increase in what they called billed business. That's just the total amount people are charging to their cards. And what were they buying? A whole lot of retail, plus we're seeing a huge rebound in travel and entertainment spending.
But you know what's really interesting? It's who is doing all this spending. Management points the finger directly at a specific group. They said, and I'm quoting here, continued strength in spending by Millennial and Gen Z card members as our products continue to resonate with these cohorts. That is a huge signal.
So, here's the big insight for this section. It's not just that people are making bigger purchases. The number of transactions also grew by 10%. That tells you their customer base is super engaged. It's like the core engine of their growth is just humming along, especially since their premium products are clearly a hit with those younger digital-first customers.
Now, look at this chart. It really breaks it down for us. You've got discount revenue. That's the fee they get from merchants on every swipe, up a solid 7%. But wow, look at net card fees. That's up a massive 18%. That's a clear sign that people are not just signing up for, but paying for their premium cards.
All right, so the revenue story is looking really strong. But how did that actually translate to the bottom line? Let's jump into our second section, the profitability picture. And here's the headline number for profit, a diluted EPS of $4.14. That's a huge 19% jump year over year. To put that in perspective, we're talking about a net income of $2.9 billion for the quarter. So how did they pull this off? Well, a big part of the answer is something called positive operating leverage. You can see it right here. Revenues grew faster, at 11%, than their expenses, which grew at 10%. That's exactly what you want to see. It's a sign of a really efficient, well-oiled machine that's scaling beautifully, even while they're investing back into the business. Okay, now before I show you a really surprising number, we need to quickly talk about something called provisions for credit losses. It sounds complicated, but it's just the money a company puts aside in case customers can't pay back their debt. Simple enough, right?
Well, here's where it gets wild. With all this record spending, you'd probably expect them to set more money aside, just in case. But no, their provisions actually went down by 5%. They basically built up fewer reserves than last year, which is a massive signal of confidence in the quality of their customers. And look at this chart. It backs that story up completely. The rate of people who are more than 30 days late on payments, it's holding rock steady at just 1.3%, exactly the same as last year. This just screams excellent credit quality. They really know their customer base.
Okay, that brings us to our final section for today, the forward-looking commentary. Let's try to get a sense of where management sees things going. So what's the outlook? It's the big question, right? Now, the company didn't give us any hard numbers or specific guidance in their filing, but what they did say, their qualitative commentary, well, it speaks volumes. Management is clearly projecting a lot of confidence. They said, quote, "We believe our differentiated business model is resilient and positions us well to navigate a range of economic environments." You hear that? The key words are resilient and navigate. They're saying they're built for whatever comes next. And really, that's the core insight for their strategy going forward. It's all built on the idea of resilience. They're betting that their premium, spend-happy customer base and their steady fee income will act like an anchor, keeping them stable even if the economic seas get a little choppy. And they've got the data to prove it. Look at this chart. The number of their own cards out there grew by 4% to a whopping 86 million.
That growing army of cardholders, that's the foundation of the whole resilience strategy they're banking on.
And if you want one final sign of confidence, just follow the money. The company sent $2.9 billion back to shareholders this quarter alone through both dividends and buybacks. That's a company putting its money where its mouth is. So let's wrap this up. What's the verdict? We saw record spending, especially from younger generations, that rocket-fueled an 11% revenue growth. That power flowed right down to the bottom line, with net income up 16% and EPS jumping 19%. All of this was built on a foundation of rock-solid, best-in-class credit quality. And looking forward, management's message is all about confidence, banking on a resilience-focused strategy. There you have it. If you got some value out of this breakdown, drop a 1 in the comments to let us know. This has been Stock AI Insights. See you next earnings.